Good morning. Thanks very much for joining us, everybody. Really interesting topic that we've got this morning, looking at infrastructure, the outlook for 2023, but also particularly looking at sustainable, green, new energy, because it's been one of the key topics that we've been discussing both in the real asset side, a much bigger interest as well in terms of the real estate side. For those who don't know me, my name is Richard Betts. I'm the publisher at Real Asset Media. We run sort of 60 to 70 of these events every year. We publish Real Asset Insight and Real Asset Impact, which is particularly focused on ESG, social impact. So particularly interested to hear what the speakers have to say, because there's a big focus on renewable energy as part of the carbon reduction, but also a very big focus at the moment in terms of energy resilience. Super panel. We're going to start just with a brief introduction from Volker Trepter of PwC, and then we'll use that as a kind of launch pad for the discussion. On the right hand side of your screen, you'll see that there's a Q&A and chat button, so please do feel free to use that. It'd be interesting to get your views and questions, and we'll try to deal with those as much as we can during the session. Thanks very much. So over to you, Volker.
Thank you, Richard. And I think as the introduction, we just want to see where we are in the future. And I think, as you know from the news, what's really challenging industry clients at the moment. And this is the point of gas shortage, security supply, resilience of energy, high energy costs. Then we still get effects on the COVID pandemic, supply chain disruption, raw material short, and then still with that we have the climate energy transition policy of the governments with the Fit for 55 program of the EU and the several local government programs, subsidy programs with price caps on gas and power, windfall taxes on electricity, and I think the current discussions we have is a price cap, a wholesale market in the gas for European gas, which is not decided yet, still in discussion. We're waiting how we see, and I think part of my government, German government, is one of them who's hindering at the moment. So let's see where the will be at the end. But these are all the topics that really influencing the industry. So resilience of energy and high energy costs, how to manage them, and also then to see like how it fits to the decarbonization agenda, which is all pushed by a lot of governments. And this is, I think, the part where we're seeing it, and here just to see how the prices develop and how the high risk for energy intensive clients is. You see the price development we have seen in 22 with the highest peak in August, September. Now we are back, but still on a high level. So we have we led to high inflation. So we still have the high inflation averaging now 7.6, depending really how you look at. And we have gas import from Russia fell approximately 75%. All Nord Stream 1, 2 not working. Question is how this will be the future, how this will be resolved. And there's still a lot of uncertainty. And you see also, besides that, there's a decline in the EUA and the emission certificates prices. So they didn't went with this price increase. They also a little bit decreased. So that's the discrepancy around the aims of decarbonize on the high prices, which have to be managed by the clients. And then on the right side, you see we made based on the development plans of for example, the governments for the buildup of renewable sources. We saw like you see how the long price trend is going. So we're coming back from really high prices, and then see that we will end just approximately estimate between something about let's say 60 and 110, 20 euro in the future. So that's the prices you need to work with on your long-term assumptions, on your investment plans, on where you're going. So I think that's really one of the important views on decarbonization and energy you need to look at, and also in real estate and assets. And I think one of the important things here is it's not only the consumption, the high price, and also you need to look at the energy efficiency. So I think that's what a lot of companies now driving, and they are getting like in two basic issues. One is safe energy, so energy efficiency, how to reduce your energy consumption, how you optimize it. Optimization means not only to just reduce, but also to use on different time periods, like gas, summer, winter, power, day, night, or other shifts, and then also thinking how I really hedge my prices to stay into business. I think it's the most important thing. If you don't really manage your pricing, and then you are also not able to manage the pricing to your customers of your product, which is produced with energy. And then this is one of the really important things on the hedging, on managing the price risk. And you see that we had in the past a lot of clients that just managed the budgeted year. So 1 year, perhaps 2 years of energy prices. And now you're seeing it's much more looking forward in the future. So they start up to 4 years before, even longer now, you will see in the next slide, to see like how they position their forward position in the market. So they see, look, what's the medium-term planning of the company? What's the planning of your consumption, of your sales? And then you determine your demand profile from historic profiles, and also with your ambition, how you see how your market will develop, and then start the hedging even up to 4 years before on a general basis with instruments. And then if you're going more in the short term, you get more granular on the hedging, because then you know really what's your budget of the next year, what's your forecast of the next year, depending on the industry. If you're really volatile products, it might be different, but most industries have a forecast. They go 1 year before, structuring their positions and getting there from managing the residual risks. This goes to the spot market a few days before until intraday. And also we see using of renewable resources, and many of industry clients also own renewable resources. They own like wind or photovoltaic PV. I think that's on real estate. If you have a land or building, so you may use photovoltaic on your roofs or even on the walls or whatever you can. It's good. Then you have the costs of the investment of the renewable assets, but also you have in this time another production profile from the renewable asset, because it will produce power once there is sun and not there, and then you will have a volatile profile of your production of power, your consumption, and you have to manage all this. And this is also something which makes it not so easy, makes it more differently. But this is the way where we see the future and where companies need to go on managing their position. And this is like, we had discussion with a lot of industries and a lot of asset owners. So how we manage it and what's the basic need. And basically then you see here then the way of sourcing option, and also the sourcing option of meeting your net zero targets. So that's high cost of energy, but still you have your net zero targets you want to achieve. And there are several possibilities you can do. It's like, one is just buying GOs, certificates of origin from renewable sources, which sometimes is called not really too sustainable in a certain way, because you say like you're just buying certificates wherever you can get them, and it's not really connection. Then you get green sourcing contracts, what is ever you heard. I think every day I get a call on how companies can enter into power purchase agreements for renewable assets, which are not standardized. They're on-site, off-site. On-site means they may be on the premises of the companies on the real estate, they may be off-site in the near connection, or they may be just virtual. So there are a lot of individual contracts you need to negotiate, and you enter into this long-term price risk, because this started 5 years, but a lot of them are 15, 20 years. So it's a really investment you're doing. And this is then something different, just sourcing, and you enter to like being a renewable investor, and the question is if you want to do this as the industrial client, or you need help from others, investors or others you have to this. And then you can go even further, strategic cooperations, or you invest directly in brownfield projects or greenfield projects. Brownfield means existing ones or new ones, or you acquire companies and build up your own developer. And all these options are under discussion with clients. And I think the last ones, the 4, 5, and 6, they seem to be interesting for a lot of industry clients. But then on the other side, you need to invest funds. So they need to have money. And many companies don't want to invest in energy sourcing. They want to use their funds for investing in their core business. And then I think that's also a lot of discussions, how you really then manage it, how you get a financial investor on board. You work with a utility. We worked on big programs of offshore wind parks, and it become quite complex with a lot of parties involved. But that's then the way how you go forward. And the good thing is that you, with all these things, you get with 2 to 6, you get in predictable costs for the future. So you're getting away from the volatile market, but also then means that the energy market is no more the price signal for your products. And then we get to the dilemma, long-term forecasting, like cash flow stability on a long-term basis, with also a net zero sustainability target you will meet, or then staying on the market on the short term and hoping that the market will relax. And this is their quite significant topics. And this is a part where we need to see like how companies will do and how they work together on the premises and with others. And I think real estate, there are also a lot of real estate parts of buildings that are not using the whole land to build up renewables. Like if you see how many photovoltaic is installed on the roofs of buildings, not all are possible to do it, but that's also a way how to increase it. And the question, who will do the investment? Is the investment done by the owner of the building, by the tenant, or by a third party, because then this is rented out? And I think that's all opportunities, how to manage it and how to see the future. Saying this one, I think that's really the main topic on this part. And I think, as I need to recap, the most important thing is basically save energy, manage the energy efficiency, and basically then managing the cost. And then the big question mark is how you see the forecasted future price. And this is then making the decision to invest now in assets or long-term, or stay on short-term because there are another few on the market. And that is basically something where companies are working on a daily basis and have to manage this. And also if they don't manage this and they don't see the decrease of price, then also the discussion on competitiveness on the clients and the future of the production in, let's say, Europe on certain parts, because one, you don't see on a long-term being competitive to other Asian or other African or whatever markets, or US, because of the high energy costs. Then you may come for new investments to the discussion where to invest. And this is also one of the long-term decisions you have to make. I think that's a short introduction from my side, Richard.
Great, thanks very much, Volker. Really interesting, I think, to get that, that introduction based around what you're seeing in terms of the clients, and also what's happening on the company side, because we're spending a lot of time looking at the investor side and what's happening there. So very interesting to see how those other areas are driving this at the moment. Super panel today to pick up some of these points. Let's start with some quick introductions. Let's start with you, Tanya, if we can. Just a brief introduction of yourself and the company and the role there.
Sure. Thank you so much, Richard, and delighted to be here this morning. Tanya Suneva. So what I do is I lead infrastructure research for CBRE Investment Management. CBRE Investment Management is an asset manager with over 140 billion of assets, and more than 30 countries in terms of presence. So I actually support our listed and also our private infrastructure strategies. Infrastructure is growing in importance across the organizations. So yeah, that's about me.
Great, thanks, Tanya. Over to you, Dave. Oh, you're on mute, Dave.
Classic. So Dave Bentley, I'm one of the partners at Atlas Infrastructure. Atlas is a dedicated listed infrastructure manager. So we run a portfolio of about 25 listed infrastructure securities, and we've been going for about 5 years, based in London.
Super, thanks very much, Dave. Jim, over to you.
Yeah, morning, Richard. I run the Premier Miton Global Infrastructure Income Fund, which is a listed infrastructure fund launched back in March 2017. Premier Miton is a UK focused asset manager, and I've been running, before that I ran a portfolio of listed infrastructure for a large UK pension fund.
Super, thanks, Jim. And Volker, although you gave the presentation, you didn't give an introduction of your role there at PwC. So just give us a brief insight on what you're covering there.
Okay, so I'm a partner of the energy industry and resources industry in PwC. So I'm heading the energy industry services for PwC in Germany, and working also on commodity trading. And basically, we are working on many sides on the decarbonization part. But I think at the moment, it's, as I said, like on a daily basis, people are calling on industry people, calling how to really go to the future. And I think that's a part where I spend now most of my time, besides discussing with governments about subsidies and how this will work.
Great, thanks very much, Volker. Jim, maybe it'd be interesting just to start with you. Obviously, huge changes over the past 12 months. But I suppose, how do you see, looking back at 2022, the influence on the market? I mean, do you think it's been a bit of a game changer, particularly in terms of the focus on renewable energy, resilience, those kinds of things?
Yeah, it's interesting, Richard. Whenever we consider an energy market, we're talking about what's been called the energy trilemma, and that's the need to balance three kind of competing factors. It's the carbon footprint and the need, as we know, to reduce emissions and to obviously tackle climate change. And I think what had happened prior to Russia's invasion of Ukraine is, clearly the decarbonisation agenda had been, coming out of COP26 this time last year, had been really strong. Affordability was we'd all become a little bit maybe complacent about affordability, and we've become a little bit complacent about energy security. And clearly taking away, weaponizing a huge amount of the gas going into Europe and then removing it completely has, is a game changer, and it has refocused policy. But I guess what is emerging is a near-term need to obviously, fix the problem, replace the Russian gas in short order. So, on days like this, we can heat our homes and keep the lights on. But longer term, a realization that those affordability and energy security needs can be met and will be met through increased use of renewable energy. And so I think, there's a lot of factors in play. It's a complex situation, but for me, what emerges as the solution is greater renewable energy in various forms, and with various sort of backups and insurances in terms of storage, etc.
Yeah, I think that's interesting. Dave, maybe coming to you, what's your perspective on that? I mean, are there positives, negatives that have come out of it? What's your view?
Yeah, thanks, Richard. It's obviously there's a lot of negatives from a political standpoint and in terms of the cost of living in the short term. So one can never, sort of gloss over those. Having said that, I think the long-term impetus that this has provided is really quite positive. So it's really put a focus back on energy security. It's meant that we cannot rely, I guess, on third parties, particularly third parties in parts of the world that may be less reliable. And so what that means, really what that's started to drive is taking the sand out of some of the gears, particularly around public policy. So what we're seeing is that one of the major hurdles to actually greater renewables investment was particularly around planning permits. And you can understand that, large wind farms do have environmental and I guess they have aesthetic impacts as well. There's always a significant time frame for planning any kind of major infrastructure investment. What this has really driven is the desire to, I guess everything's a trade-off. So the trade-off just used to be sort of birds for electricity. The trade-off is now kind of much more, well, yes, there's lots of environmental issues that need to be considered when you say build a new piece of generation. But on the flip side, we need the energy. We've got a much stronger desire for energy self-sufficiency, and I think that there's a general political willingness and desire to, I guess inflation's having quite a strong societal drive to improve energy resilience and reliance. So net, net is probably the wrong way to put it. In the long term, I think this is going to really free up the planning process, and actually long term it's probably going to lead to much quicker deployment of renewables.
Okay, that's interesting. Tanya, I wanted to pick up with you. Feel free to come in on any of those views about, I guess, what we've seen over the past year. But, as an investor there, you're also looking at the macroeconomic outlook. And that has presented a kind of unique set of challenges in a way as we come out of what's been a decade of cheap money. We've got rising interest rates, certainly uncomfortably high inflation if you look at the UK, but also Europe and other areas in the world. And we've still got continuing supply chain disruptions. So I guess a lot of challenges there in terms of infrastructure investing generally.
Yeah, I think it's true, and I'll start by saying that I think Volker's picture, the first one that he had, was quite revealing. I mean, there's a lot of dark clouds ahead of us, and in terms of the macro regime, we're coming out of a decade of cheap money. That's definitely changing. We have uncomfortably high inflation. We also, I guess, we have a guaranteed recession in Europe, a technical recession in the US. So really a lot of challenges ahead of us. But what does this mean for the investing outlook for infrastructure? It's a question that we ask ourselves. And as I said in the beginning, the infrastructure platforms, at least with our organization, are growing in importance. And there is a reason for that. I think infrastructure investing is poised the best in relative terms in this type of environment. And I think that the resilience of infrastructure assets is something that will stand out. So I think when we kind of look back and when we look forward, we're running from one crisis to another crisis. And while we're running from the pandemic, we still have the late stage recovery. We're going, and we have had a period of energy crisis, most acute in Europe. That's a test for infrastructure. And I think that infrastructure was quite successful with the first test. When we think about the pandemic, I was actually rating airports at that time, severe, hit on their earnings, no volumes for a period of time. At the same time, infrastructure overall as an asset class, I think we should stop and reflect that it wasn't affected as badly. I mean, there's other sectors as well, like digital, for instance, that really picked up quite well, that, were kind of successful. So when we look ahead in terms of our outlook, I think all of us should consider that infrastructure is quite heterogeneous. It's a diverse asset class. We have very high commodity prices and some Companies like power generators are going to be impacted. We have, obviously, it's going to be upside earnings to LNG exporters, but at the same time, sectors like renewables that we're going to talk a lot about today has a lot less exposure either to the macro cycle as well as to commodity prices, to the extent that, like they operate under feed-in tariffs. So looking ahead, I think, like we will have another test for infrastructure, but the diversity of the asset class and the resilience of the cash flow gives us confidence in terms of, like where the asset class will end up.
Okay, good. It'd be interesting to, and feel free anybody to pick up any of those points. It'd be interesting to think just to look at the key drivers as well for that transition to new energy in a minute. But Dave, you wanted to pick something up there.
Yeah, I guess I'm just picking up on what was said. There's a real tendency, I think, particularly when we're in periods of crisis, is to kind of look at our shoes a little bit too much. And infrastructure really, if you think about a long-term asset class, it doesn't get much longer term than infrastructure. And really, the challenge for any investor is to try to avoid either catastrophizing or getting too enthusiastic about short-term events. And that's particularly the case in infrastructure. And in a sense, what we're trying to do is constantly go, okay, there's the short-term impacts, but really it doesn't actually have that much of an impact on. If you've got an asset that has a 30 to 50 year lifespan, what happens tomorrow or the next day is actually relatively, it's not just relatively, it's basically tiny. The market will, be either catastrophizing or getting too enthusiastic about some stuff. But I sort of constantly encourage both the people that work in our team, but also, I guess, all investors, is to really kind of look ahead and say, okay, what are the implications for this from these events in terms of the long-term investment sort of thesis for our assets? And really what that means is that actually when you look ahead, whether it's 10 years or 20 years or 30 years, we kind of still know where we're going. And actually that can provide a little bit of comfort amongst all the stress. So it's very important to continue to really look at what the drivers of valuations are, not just the drivers of sort of next year's EPS.
Yeah,
Richard, when I might add, I think the investments also in infrastructure are significantly increasing. It's not only the renewable, it's also the grid. You need to adjust to be able to deliver or the electricity and the buildup of LNG terminals, hydrogen grid, whatever. And this is really demanding. And this is, I think, if you see like from the company side, like the grid operators or the energy companies, there is tremendous need of investments for this one. I think one of my clients predicted 150 billion euros for the next 30 years of investment for one company. So, and then you go to the whole market, there's this really huge amount of investment needs. Question is, as I think David, you also said, question is how predictable are the return? Because this really depends on how stable the market design will be. So how the grid operator will be paid. Normally it was stable, they get like a fixed income, or fixed dividend or income over the whole period. And I think that will be interesting for the investor side, how this will change. Will the market design change, the market condition? But if this stays like stable, it will be stable in a certain way. The only question will be how affordable will be it for all of us, because the screen costs will all be at bars. But then this is a huge demand which will coming, and the companies are not able to invest them from their own resources. So they need to have investors to be part of it. I think that's something which will, with a renewable build-up, will be really challenging for the future, and huge opportunities also.
And Jim, just coming to you on the capital, feel free to pick up on any of those parts. But looking at the capital flow side of things, is there still capital on the sidelines looking to come in? Is it still an attractive asset class? Are people buying into that sort of? There may be some short-term negative elements, but actually medium and longer term, this has to really be a huge opportunity.
Yeah, it is. I suppose I'd make 2 points, and I think Volker's point was well made, and the key is the regulatory and political support. And what I suppose concerns me a little bit is that at a time of bill inflation on the back of high commodity prices, high gas prices, particularly in the UK and Europe, but you've seen this in the US as well to a lesser extent. Do the politicians and regulators understand, and do they have the confidence to permit and to remunerate the necessary grid growth that we're going to need in transmission and distribution to meet the challenges, to hook up new renewables to the grid, to facilitate electric vehicles, maybe, electric heat pumps, etc. All of this requires huge grid investment. Now, the grid, the network part of customers' bills is relatively small. But it does need to grow, and we know that, and it's an investment in the future. And as I say, it's whether the politicians and the regulators have the confidence to allow that, and have the ability to see beyond the next 6 to 12 months. And certainly in the UK, I would argue perhaps that hasn't been the case in the last 6 to 12 months. The second point, though, is that private capital is very significant here, and what we consistently see, and I'm sure the other listed infrastructure managers, can see it as well as I can, is private buyers, pension funds, sovereign wealth funds, private equity funds, the likes of KKR, and the behemoths of the US private equity industry, investing in listed assets, and in many cases SSE recently being an example, selling a proportion of their UK transmission and distribution business, to private equity buyers, private capital, very, very keen to invest and very, very keen to deploy capital. So I think if the investing environment is right, there is abundant capital for this, but it really is down to the regulators and the politicians to set the tone, set the tenor of investment.
And Tanya, are you also seeing that as well on the non-listed side, on the fund side?
Yeah, we're on the flip side of things, and I definitely would say that 2022 was the record year in terms of fundraising, and that comes after another record year in 2021. So what's happening is that we're actually having a build out of the private infrastructure asset class, and this year the fundraising is in excess of 150 billion. That's data from InfraLogic, and in comparison to 2020, that's 50% higher. So definitely there's a lot of money flowing in. Again, kind of my interpretation of it is that it is because we have a resilient asset class, the appeal of infrastructure in a downturn, but also all of this, kind of the ESG check. Many of those investments that this capital will pursue will check, I think, and have environmental benefits associated to them. So definitely a lot of dry powder in the field. And I think what's good as well is that there's more sophistication. There's a lot more different strategies. And again, it's not just the core plus type strategies. We're seeing a lot more value add, opportunistic. We're seeing more secondaries bringing in with liquidity, which I think is good, not just in terms of, what type of companies you pursue, the exit horizons, etc. But I think it's good as well because we'll add this or allow investors to differentiate. So obviously the prospects on the private side are even higher this year.
Okay, good. It'd be interesting just to pick up a little bit more on the transition side, I suppose. And Dave, maybe coming to you, just in terms of that transition, over to clean, green, renewable sources. What are you seeing there, I suppose, as some of the key trends? If we're looking at, we've seen a huge amount of activity, for example, in terms of what would be traditionally real estate investors investing into solar farms. So I guess, what are you seeing in terms of some of those trends, looking at solar, looking at wave, looking at, you know, the sort of more green energy sources?
Sure. I mean, I'm probably not the best person to talk to on this, really, because we're seeing a lot of investment across the board. I mean, really, it's still in your, from a renewable standpoint, it's still in your usual kind of three buckets: onshore wind, offshore wind, and solar. Of those, kind of solar is probably the UK aside. Solar is probably the dominant player, particularly when it comes to the US. When it comes to Europe, there's a lot of, in the north, obviously, there's a lot of offshore, and in the south, a lot more solar. What I think is probably an important point to note is, firstly, obviously, the source of energy is very geographically particular. So it's kind of not like, everyone jump on the solar bandwagon or everyone jump on the onshore wind bandwagon. It's very much horses for courses from a geographic perspective. One of the things, though, I think that if we can take an overarching trend, what we're seeing is a continued, and it is a continued fall in the price of new developments. I mean, the cost of capital increases have made that more difficult, but just things like ever increasing wind turbine sizes, ever improving efficiency of both the solar panels themselves and also the ability to roll them out efficiently. We just continue to see this like a secular trend in reduction of new energy costs. Now, we don't expect that will kind of, it has to flatten eventually, but basically, I think one of the things that we see longer term is, and I guess we've had a nuclear fusion breakthrough, if you can call it that, generously, in the last couple of days. One of the things that we do know, I think, is that energy, if we look forward in 20 or 30 years, even 10 years for that matter, energy will actually be considerably cheaper in 10 or 20 years than it is today. And I think that's going to really, that for an investor, they really need to be cautious of that for two reasons. One is, if they're investing in, say, a renewable project today, and obviously you'll often invest in a renewable project and half of the lifespan of the asset will be contracted, but the back half of the asset will be left sort of merchant, or will contracted sometime in the future. The risk that I think investors should be just aware of and talking to their investment managers about is, given that in 10 years' time, it'll probably be half as cheap to just build a new wind farm as, what it costs to build this wind farm. Why do I think I'm going to get this kind of long-term power price that's based on today's price, when actually the cost of new generation will continue to fall? I think there's a lot of projects out there today that are making heroic assumptions about long-term power prices. So that is one thing to be careful of. The other thing, flipping to the positive side of that, I guess you could say, is that we see energy supply becoming much more like your kind of internet at home, where you're paying for the connection and you're paying for the availability of a resource. You're not really paying for the resource by volume quite as much. So, the prices, I think Jim mentioned, that the investment really, there's a massive amount of investment that's going to have to be required in the poles and the wires to bring both a new generation on, and also to fortify the network for probably a doubling or tripling at least of the use of electricity over other energy sources. So your bill is going to be increasingly made up of that fixed portion of network charges. Now, in a sense, that's actually quite good, but it really changes the game. So when I think about investment opportunities, when I look at, okay, I could invest in a renewable energy asset that, has some quite material uncertainties at the back end, or I could invest in a network that will continue to require investment and will be continued to be actually supported by a regulatory regime because we need it. We tend to really favour, investments in assets that we really know we have a much better visibility to over the longer term. So it's a good news story, and maybe a word of caution on some of this investment.
Okay, interesting. Does anybody else have a perspective on that? Because I think that long-term perspective is really interesting.
I think one will be interesting is the development of the new market design. And I think what we see, as David said, it will be not like a full local, like a UK market or continental Europe market. It will be local markets. And I think then in an investment, you need to be careful where you invest. I think at the moment now with the regimes, you could invest in a country wherever you don't really look at the location because you get the fixed price or subsidized price, whatever. And this will develop in the future in a new market design because it's not working at the moment, the classical one, and all governments working in it will be local markets. And if you have a local market with too much renewables, they're not needed, the price will be affected. So you need also, I think that's something new. You need really to look where you want to invest and where you see where's really the need, where are the consumers in this area and how they are connected, how they will be connected, because at the moment already more than 5% of the renewable produced will be not feed into the system because it's not possible, because the grid is not capable of doing it. So I think you have to look at this one as an investor, and there are a couple of risks coming in for the future, say we said on the long term. So on the short term, you still can say like, yes, the subsidized system of the governments are there, it's fine. But on the long term, it will change the market design, and then you perhaps will be exposed to risks. If you don't really look deep into it or thoroughly, there will be surprises on the project, on your investment in the far more than 10 years, and this will be affect then your income. And I think that's something that's very important you have to look at.
Yeah, I also would kind of agree with that. I think that definitely renewables are going into a new life cycle. Like they've been a stage where it's like it was important to get the technologies working, to get them to a commercial kind of stage. And we've passed this stage. I don't think we have any issues with the technology. The costs perhaps will increase. I mean, they have in 2022, 2023, but overall, renewable is so cost competitive, and with high fossil fuel prices, it will be even more competitive. So I think where the new kind of life cycle is that, we have a lot more merchant risk and, renewable projects coming in with a lot of assumptions about the price evolution, which is fine, I guess. But then when you look at the returns, which have also touched lows, are these returns commensurate with the risk profile? I think that's a key question, because merchant power, I mean, nobody can really project the evolution over a very long period of time, while the returns are, I say, not yet reflecting the new realities. And plus, when we, I think, consider the rising interest costs as well, the high leverage of renewable farms, I think, we really have to take a pause and think, what do we expect? What are the fair returns of a renewable project so that we unlock the full investment potential?
I tell you what's an interesting case study as well is that the what's happened with the Inflation Reduction Act in relation to US solar. So basically, the subsidy for US solar was always an investment tax credit, and as the cost of solar has shrunk, therefore the benefit of that investment tax credit, you're investing less, so that tax credit amortized over the life of the project, that tax credit, that subsidy is shrunk as well. So what the Inflation Reduction Act allowed is for solar developers to actually opt for a production tax credit. And obviously the production, if anything, with the efficiency of PV cells is accelerating. And so actually the developer, whether that's, an independent developer, a regulated utility, whoever it might be, can pull through the subsidy much, much quicker, getting it on production rather than investment. It sounds like, a very boring accounting kind of thing. But actually what it means is, for developers and utilities, it means that firstly, they are more likely to develop and to accelerate development if they're getting, you know, this bigger, quicker subsidy. And secondly, for regulated utilities, it means they can pass that benefit through to their customers more quickly as well. So, you know, not only are they more likely to invest, but the customer who's seen bill pressure from his or her fossil fuel power source will actually be seeing a benefit from solar, from, you know, its inherent cheapness, but also the tax subsidy that the government's giving. So I think, again, you know, the points made on, you know, keeping an eye on the economics of renewables and the return profile are absolutely spot on. But again, I think regulation can help so much to, you know, determine where the investment goes.
And
Yeah.
at the moment, is most of this regulation, if I'm looking at Europe versus the US, let's say, is most of the regulation here in Europe stick rather than carrot, in a sense that it's you know, it's driving the market, but not using that sort of subsidies for incentives.
I think
Dave, you want to pick up that point? Yeah.
I think that's a pretty fair point. Historically, that's definitely been the kind of bifurcation of the regulatory market. One of the interesting things is, I think, what we're, again, due to what we're seeing in the market at the moment, which actually should have some good positive long-term implications, particularly for renewable developments, is that the European market historically, maybe this is getting too technical, but the European market historically has really relied on kind of a very like a competitive mindset to drive down energy prices and to get the most efficient marginal price. But that generates quite a lot of uncertainty in the market, and it can have some quite perverse impacts. What we're actually seeing in Europe is a push towards a situation where renewable projects will be able to be contracted for a lot longer, and where we'll be able to have you know, PPAs, and where the price of power, rather than being set by some complicated, you know, 5-minute competitive process, is actually set much more through, you know, I'll build this wind farm, you know, with a long-term with this long-term cost, and basically it'll be set based on just whatever it costs to build a particular asset, rather than who's generating renewable energy at a particular point in time. That should generate quite a lot better stability in the market, and probably actually have again, provide some support for new projects coming on board. That, combined with the improvement in planning regulations, could actually be quite positive for a lot of developers.
Okay, good. Tanya, I wanted to pick up with you. Just, I mean, we mentioned briefly the kind of war in Ukraine, but has that sort of changed the investment paradigm more generally in favor of new energy? Generally, do you think?
Well, I'd say that the short-term focus is different. In 2022, it was really energy security, most acute the crisis in Europe. I think what's happened as a result of that, when you think about the government's policies in the European Union, we see the REPowerEU plan, and it really has a focus on, well, we need to reduce our dependence on Russian gas, and how we're going to do that. I think they've done a pretty decent job this year. Obviously, as we say, we have the heating in our house. I'm based in Dublin. It was -3 degrees yesterday, so thankful, I mean, of what we've done. Obviously, it came at a very, very high cost in this year. And I said that the energy security dimension is going to be the leading dimension next year, probably the year after, because you cannot change the energy mix in a year. It's going to take a while, I think, you know, to really put in place more LNG terminals, to have more flexible storage, you know, like there's going to be a lot of investments in order for Europe to have more resilient supply of power. But I say that again, longer term, the end game is decarbonization. The end game is to, you know, achieve clean energy. And the good news, because we mentioned a few times the Inflation Reduction Act, The good news is that I think the policymakers, they understand that you cannot just tackle one. You cannot just focus on energy security in 2022. You really have to do like both of them at the same time. So the Inflation Reduction Act, it has about 369 billion of incentives for clean energy. But at the same time, I think the good news about that policy and legislation is that also it is thinking about domestic manufacturing for key components. It is thinking about, well, in the medium term, let's also have the supply chain. That's so critical, in order to have a local production as well of those components that are needed for US solar. So I think that, again, we will be tackling a lot more energy security questions in the next 2 to 3 years, but we're not going to lose sight of the end game.
Okay, good. That's interesting. And I wanted to turn a little bit to particularly sort of opportunities here and what we're seeing at the moment in the market. I mean, do we see more, there's a lot of discussion around nuclear particularly, and Dave, you mentioned there already the nuclear fusion mini kind of breakthrough where for the first time it's actually created more energy. There's been more energy output than the input, and a lot of discussion around that. So whether or not nuclear is then going to be more of a clean green solution going forward. Lots of discussion, mainly from from oil and gas companies around carbon capture. But I suppose, how do we see the mix and how do we see that transition? Because obviously there is a big reliance on oil and gas at the moment. And somehow that transition has got to be managed, as you mentioned, Tanya. I mean, how do you see that from an investment standpoint, Jim?
Well, yeah, absolutely. Nuclear is amazing, isn't it? The rehabilitation of nuclear. So, it's only a decade ago that perfectly good nuclear power stations were being closed down in Germany based on policy, and it's been incredibly difficult to build large scale new nuclear in the United States, in France, in the UK, etc. Now, whether modular nuclear reactors are the answer, I don't know. I genuinely don't know. The theory is great. My concern, one of my concerns, is around the security. The physical security of plants. If you've got more nuclear plants, that does create more of an issue. But to your broader point, yes, this is an energy transition, and the need. It's interesting, the evolution of gas as well, natural gas, from an unwanted fossil fuel to something that actually, if it displaces coal, if you can use renewable natural gas to an extent, if you can use natural gas that's certified as produced under certain kind of ESG standards, that does now become an acceptable fuel over the next decade. So I think yeah, it's a transition, and there's going to be a lot of moving parts. Some we can understand right now, some, like nuclear fusion, we don't quite know what it might mean, but it could be incredibly interesting further down the line.
And in terms of the, I suppose, Tanya, just coming to you, in terms of some of that energy infrastructure that we're using at the moment for gas, there's a big discussion in the real estate side about, we want to stop knocking down buildings and actually, convert rather than demolish and rebuild. Is there a lot of this infrastructure that can also potentially be reused for new energy, or will we be left with that idea of stranded assets that we've also got in the real estate side?
Yeah, well, I think the jury is still out, right? Like, I think when we say transition, it is a transition. It's not a path. I think there's going to be different paths and different ways we can get there. I think we actually have an idea where we want to get, but we don't know exactly how we're going to get there. And the reason why I'm saying that is, again, that in the meantime, there's going to be a place and a role for different technologies. There's going to be, like a place for probably nuclear. They may be as well. Again, like gas peaking plants as well that are needed because we need to balance the penetration of renewables and their intermittency. I mean, there's going to be a lot of options and we need to keep our eyes kind of open. I think that's the exciting part of it. The less exciting part of it is that, as you say, Richard, I mean, some of them might turn out to be stranded assets. And I think that's the role of, like us in kind of as an investor is really to think about, okay, well, what and how big is that risk in terms of stranded asset risk, but as well, how can we decarbonize the legacy assets? Because all of them, I think, are going to have a role to play in the 2030s and 2040s. And there's going to be a different role as well. For instance, if you think about gas pipelines and some of the pilot projects in terms of feeding in, be it hydrogen or blending, gas, I think they may show some potential. And in the 2030s, there may be a case for clean gas capex, but again, there's also question marks. So I think, we need to keep our eyes open on all of the options in this journey.
Great. There's only kind of 5 minutes left, so I just wanted to pick up from everybody. Looking particularly at the opportunities here. So I guess, what are the opportunities that you're most excited about? And that can be for 2023, but it can also be, further ahead. So who wants to start with that? Should we start with you, Dave? What are the opportunities that you're most excited about?
What we try to do, rather than, as I said, I mean, this is maybe very boring, but we're infrastructure investors. What we're trying to do is work out what are the sort of the lowest risk things that we can actually have some confidence in, and just to pick up just quickly what we were talking about with the reusing or doing something with pipelines. Yeah, that may or may not happen. It's pretty unclear. It's very hard to back that as a business case, and a lot of these assets, even if we have hydrogen and natural gas, they're going to be stranded. So if you're looking to put money into infrastructure, what I think we need to do is look ahead and say, okay, what is the confidence that we have that these assets will be needed in 20, 30, 40 years? For something like a gas pipeline, maybe not, don't know. For a solar farm, probably, but we don't quite know exactly what the generation mix is going to be. The thing that we do know is that the secular trend is for reducing energy cost, but massive increase in sort of the use of electricity in the energy mix, and that's going to require massive investment in energy grids. And so the thing that, to the extent that I can get excited about anything, it's the most unexciting part of the infrastructure market, which is just electricity, poles and wires. Not sexy, but probably the most fundamental change to our energy system. It's going to be enormous, and it's going to require massive investment. It's probably the safest and most reliable place to get actually pretty good returns in the medium and longer term.
Okay, great. Well, look, I'm going to get excited about that opportunity, Dave, even if you can't as an infrastructure investor. Jim, coming over to you.
Yeah, briefly. I mean, I think you can't underestimate the impact of the Inflation Reduction Act in the US, setting a policy framework for over a decade out for investment in wind, investment in solar, investment in battery storage, and what that means for the US in terms of decarbonising, getting rid of coal in particular, in many of the regulated utilities at a quicker pace than we had originally thought, and getting that sort of magic combination of decarbonisation and economic benefits for end consumers. So I think the US and the US regulated utilities I'm extremely excited about.
Great, thanks very much, Jim. Volker, over to you.
I think one of the investment will be important is the storage of energy, and I think that will be the key game changer. It might be hydrogen, might be batteries. I think we need to be technology open. Once we have the right technology, the right cost, I think this will be one of the most interesting investments with also a higher return. Because once you have this and you invest in this, then you can balance the market. You can choose the opportunities in the market developments. So I think that's what one of my opinion, one of the game changers that will be really interesting besides the grid, what you said before, but I think that will be interesting.
Okay, great. Tanya, last words to you.
Yeah, well, I think for me, the most exciting part is how things are getting together. They're coming together. I mean, first we were investing in renewables, then in electric mobility. We like the electrification of transport. Then we talk about electric vehicle chargers. But now I think that actually you can invest in all three of them under the same platform. And I think that's great because actually it gives you the optionality, it gives you different revenue mix, like you really have to think about clean energy as not just one thing, but the entire value chain that now you can just combine and make a return on.
Yeah, no, I think it's really interesting. Lots for me to think through about this particular topic. I think we've got a huge amount there that we've covered over this period, and I can see that this is going to be a topic that is going to continue changing, I think, for some period to come. Thanks very much, Jim. Thank you, Volker. Thank you, David and Tanya. Really interesting. Thank you to everybody for watching. If you're watching this on demand as well, thank you for joining us. This is the last one of 2022. So season's greetings to everybody, and look forward to seeing everybody in 2023. Thanks very much.